Hey, it's Jordan from Outweigh here, coming to you this week about credit ratings. Now, picture this. You're on your way to purchasing the brand new car you've been dreaming about, and you've been spurred into action by acting on an ad you've spotted offering crazy low rates for finance. This is something I can afford, you think, as you stroll into the dealership, snapping your step. It's a sign from above. You can finally move on from that crappy hand-me-down car that backfires and rattles and wakes your girlfriend's parents up at night. But when you get to the finance stage of the process, you hear, I'm sorry, your credit score isn't high enough to access this deal. And what follows is their offer of some substandard rates that would leave you back on a diet of 2-minute noodles. Welcome to the ratings ladder. Hey there, I'm Jordan from Outweigh. If you've ever felt like your financial dreams are slipping away because of a pesky number on a credit report, you're not alone. I've spent over 15 years in the banking industry, and today I'm breaking down the world of credit ratings in Australia to help you manage your credit effectively and climb the ratings ladder. So, many of you probably have an awareness of credit rating bodies. CRBs, as they're named here. And many are probably aware of the fact that these agencies track and score almost every person, calculating a number which is used by financial institutions, phone and power companies, and increasingly in some industries, employers, to make decisions about whether you qualify for lending and at what interest rate. But let's just clarify exactly who these people are and what they are doing. Credit rating started in the 1950s in the US as a way to achieve a standardized approach to assess the credit for people when they're applying for store credit. Nowadays, CRBs are sophisticated data gathering houses who are authorized under our privacy regulations to gather all kinds of data about individuals which could be relevant to whether that person is creditworthy. The data is gathered even if you didn't explicitly consent to it and available for use by companies who issue credit. Although when these companies want to access that data, they do need your consent. The 3 CRBs active in Australia are Equifax, Experian, and Illion. Each one uses a proprietary algorithm to produce a credit score based off your data, but the outcomes and drivers across the scores are similar across the 3 CRBs. So, given there are some similarities, what does your credit score actually mean? Essentially, it's a measure of how risky you are to lend to. Higher scores indicate lower risk, while lower scores indicate higher risk. Here's a quick rundown of the scoring ranges used by the major CRBs in Australia. Firstly, excellent category. This is like having a gold star for your financial reliability. Scores range from 800 to 1,000 for Illion and Experian, and 833 to 1,200 for Equifax. Very good. You're still doing pretty good here. You're seen as a great low-risk borrower. Typically, scores range from 700 to 799. Average. You're in the middle of the pack. Neither risky nor exceptionally reliable. Scores in this range generally fall between 500 and 699. Fair. This is where it starts to get a little bit problematic. This indicates some risk and lenders may be cautious. Scores are usually in the range 300 to 499. Low. This indicates some serious problems, and it's a warning sign for lenders showing a high risk. Scores are below 300. Your score is an indication of your creditworthiness, impacting lending decisions, which means approval or decline, and in many cases it also influences the interest rates that you qualify for. The score is meant to be interpreted as an indication of how risky you are to lend to. So, what is in your credit report? Your score will come as part of a full credit report, which is like a detailed snapshot of your financial life. It includes all your basic information like name, date of birth, addresses, including previous addresses, and where you've worked. It also keeps track of your credit accounts, showing when they were opened, what your limits are, and with which lender. The report notes your repayment history, highlighting on-time repayments and any times when you've been late. Plus, it lists all the credit inquiries made by providers and includes any legal actions or public records tied to your credit history. And this, for example, includes defaults and disputes about credit and any time you've been taken to court. There are several things you can do to improve your score or prevent it from deteriorating. There are also several things people often worry about which have no effect. So, what can you do? First of all, get credit. Now, this isn't that hard to do since most people start their credit journey as a teenager with some kind of phone contract or some kind of afterpay deal. When you move out of home, your utility providers will start a credit account in your name, and that essentially kicks off your credit record. But if you've never taken up a credit product, you may not even have a credit score. At worst, you will have a score, but it will sit on a default number within the average range we talked about before. When you first get credit and start making your payments on time, your score doesn't instantly increase. It increases slowly as long-term evidence of your on-time payment is accumulated. So, number 2, get older. Seems unfair, right? Unfortunately, the assumption that younger people are less disciplined and less experienced and more prone to error is pretty pervasive. For example, it is common with car insurance that younger people will pay more than an older person, even if they've had a perfect driving history. This is one of those annoying and systemic facts of life. Age is built into the algorithms that produce creditor scores, as they are built into the algorithms which produce insurance policy prices. Number 3, pay on time. A single late repayment will not destroy your credit score. Accidents do happen, but frequent or recurring late payments are indicative of poor discipline, and that will affect your score. And I should say, as a little aside, discipline is important. People who mean well and have a great character and will always pay back their debt are not necessarily going to be scored highly if your history indicates poor discipline, unfortunately. The length of payment arrears is also important. If you are 3 months behind on a single payment, that will have a larger impact than being 1 month behind on 3 occasions over a period of time. Subject, of course, to the point above, which is, don't let this be a habit. In short, do everything you can to pay your dues on time. When you sign a credit contract, you are pledging your name and reputation that you will return the money you borrowed. Number 4, get ahead. Maxing out your credit facilities all of the time is not a good look, I'm afraid. This especially applies to forms of personal credit such as credit cards, overdrafts, and personal loans. Pay credit cards off in full each month, which is the best practice, or at least make more than the minimum required repayment. Less important are mortgage loans, such as home loans. Paying more than the minimum helps, and it certainly gives you a much better financial outcome personally, but it doesn't have a large impact on your personal credit score. Simply meeting the repayment is what's important for those types of loans. 5, don't be too much of a player. Yes, here is a really weird one. Offers of credit are abundant. You hear things like, it's so easy, balance transfer with no interest for 12 months, fast, cheap, and by the way, never believe that, etc. The list goes on. There's lots of offers for cheap and easy and fast credit out there, but they are often the forms of credit which hurt your record the most. And the fact that you are applying for credit more often is a problem as seen by the credit reporting bodies. Here's the rule. If you don't need it, don't get it. Constantly rolling over your credit card balance with every new offer is not good for your score, even if it's incredibly easy and just means that you don't have to pay anything off, and why not? Accessing easy money to buy anything you please or go on holidays rather than just saving up for it is also not good for your score. Accessing payday lenders is a really good indication that you don't live within your means. Focus more on budgeting or ways to earn more and avoid the impact on your credit score. The frequency and type of applications on your record matters. Lots of applications for personal credit will worsen your score. 6. Get your report, check the details, fix mistakes. You are entitled to a copy of your credit record for free every 3 months. Instructions on how to do this can be found here. Once you have the report, ensure you query or fix anything that doesn't look right. Each CRB offers a process to inquire and correct your record. More complex matters can be addressed by a credit repair lawyer, and there are several we can recommend to you. Again, some instructions in the links below. 7. Give it time. With a history of on-time payment and responsible use of credit, your score will improve, and that's regardless of whether you've had some issues in the past. This can take years sometimes, depending on the size of the problems you've had, but it will happen. So what doesn't matter? Some things like your employment status, even though it is noted on the record, do not have an effect. Salary isn't recorded and it doesn't have an effect. Rental payment history doesn't have an effect, unless, of course, you got into some kind of dispute over non-payment and your landlord took you to court, in which case that will show on your credit record. The other thing that doesn't affect your record and doesn't show on the record is HELP or HECS debt. Checking your own credit score doesn't have an effect either. Even if a credit application that you make gets declined, it doesn't necessarily affect your score. Only the fact that the inquiry was made is recorded. The result is not recorded. So if you apply for a home loan and don't get it, you will see that application on your credit record, but it probably won't have much of an effect. But if you make multiple applications for personal credit, as we discussed before, whether you got it or not, the very presence of those applications, particularly over a short space of time, well, that can have an effect on your score. Okay. So we admit there's a very big brother feel about credit scores. No one likes being told they measure up poorly, especially when the scoring system is opaque and sometimes doesn't acknowledge your true individual circumstances and character. I mentioned before about the person who really does intend to pay people back, is just a little bit loose with when they do it. But credit scores are intended to assist and speed up credit applications. Unfortunately, in some cases, they can marginalise people if they haven't been taught about how to manage these scores. Nonetheless, the credit score is a fundamental part of our financial system. We have laws that cement their position in our financial system. And they will influence your future applications, whether it's a decision between approval or decline, or whether it's simply to do with your rate. One way to think about this is to remember that your credit score is intended to reflect your reliability in repaying borrowed money. So treat it as a proxy for your financial reputation. And that helps you approach the topic of credit scores much more positively. If you're ready to take control of your financial future, reach out to us at Moutway. We'll guide you through the process and help you find the perfect loan for your needs. If your credit score has been affected, there are options, and there are also many loans that are assessed without even looking at credit scores. So there's always a way. And if you're in need of credit repair, there's always a way there too. So until next time, happy credit building. We'll catch you then.